Good morning, everyone. My name is Dave Martin, and I'm a partner in Cummings and Lockwood's litigation group. Part of my practice includes handling tax controversy work with the IRS and the Connecticut Department of Revenue Services. Today, I will be presenting on DRS domicile audits and appeals. So the DRS has recently become more aggressive in seeking to tax individuals who change their domicile. Perhaps not surprisingly, this has coincided with a continuing population decline in our state. This means two things. One, there's a smaller tax base to fund the state's expenses, but two, there are a lot of people that the state can target for an audit. As this chart shows, between 2014 and 2017, Connecticut lost about 21,000 more people than it gained, landing the state at number 42 in the nation for net migration. As the baby boomers retire, we anticipate further declines in the population as people move to states like Florida, where there's no state income tax. As a result, we believe that we will continue to see more domicile audits. Domicile is defined in the Connecticut regulations as the place which an individual intends to be his or her permanent home and to which such individual intends to return whenever absent. One's intent is really critical in making an effective domicile argument. For whatever year your client is claiming that he or she is no longer a Connecticut domiciliary, you will need to establish that they had an intent to abandon their Connecticut domicile the year prior. And we're actually going to come back to this point when we discuss a domicile audit. So, what makes you subject to income taxes in Connecticut? Well, for one, if you're domiciled in the state, or two, if you spend 183 days or more a year in the state and maintain a permanent place of abode here. That would qualify you as a statutory resident. Now, Connecticut will not tax Connecticut domiciliaries if they can satisfy those three requirements listed on the slide, where they have no permanent place of abode in Connecticut, they've got a permanent place of abode outside of Connecticut, and they spend no more than 30 days a year in Connecticut. Now, this is obviously very challenging to satisfy, and the DRS will often use this third category and try to apply it to the so-called snowbirds during the year when they're changing their domicile. Snowbirds are, of course, those people who maintain property in Connecticut but live in warm weather states during the winter. We've noticed a significant uptick in domicile audits recently. These audits are typically conducted via mail or email. If your client is audited, be prepared to deal with multiple rounds of document requests. In the audit, one of the first things that the DRS will look for is whether or not your client spent 183 days in Connecticut, because if they own property in the state, then this would automatically subject them to income tax liability. A day calendar of locations is very helpful in this regard. If your client does not have a day calendar, the DRS will review credit card bills and cell phone logs to determine whether the 183-day requirement can be satisfied. Connecticut's regulations list 28 other factors that are used to determine one's domicile. This summary list shows some of the more important domicile factors under the regulations. I'm not going to read them all, but I'd like to highlight a few. There often tends to be a focus on whether or not the Connecticut property was retained or sold after the move. That factor tends to be given more weight, even though technically under the regulations, no factor is to carry more weight than another factor. If the Connecticut property is not sold and is in fact retained, then generally that's going to be a strike against your client. Also, the date when a mailing address is changed with the post office comes up quite a bit. The DRS will look at credit card bills to try and determine when that UPS charge was incurred and when the mail forwarding address was changed. The best advice that I can give is to try and make as many factor changes as possible prior to the date when you're claiming a domicile change or very shortly thereafter. For instance, if your client is registering to vote in the new state in November of 2019, but claiming that she changed her domicile in 2018, that's not going to be very helpful. One other note on the factors, charitable contributions are specifically excluded from the list of factors to consider in determining the domicile. The DRS is not interested in those contributions. So as mentioned earlier, really the critical showing in any domicile case is one's intent to abandon a Connecticut domicile. You must show when that date to leave Connecticut was, and if a factor analysis is applied, that the factors weigh in favor of a foreign domicile as of that date. At the conclusion of a DRS audit, if there's a finding of income tax liability, your client will receive a proposed audit assessment notice. In this notice, you will be notified that you have an opportunity to seek an informal conference with the DRS's audit division. This is essentially a settlement conference. Prior to the conference, you'll be required to provide a position statement explaining why you disagree with the assessment. In the position statement, you'll want to identify the best legal arguments concerning why the domicile analysis of the DRS is flawed. If you're unable to settle the matter with audit, then a notice of assessment will issue. One thing to keep in mind is that interest is running during the audit and the appeal at a rate of 12% per annum, which is obviously fairly high and can add up over time. So, what's the next step if you can't resolve the dispute with the audit division? Well, you'll need to file a protest with the appeals division within 60 days of receiving the notice of assessment. Appeals is a separate unit within the DRS. You will be dealing with completely different people than those who handled the audit. Your protest should make legal arguments based on the fact as to why the DRS's domicile findings are incorrect. Most cases settle at the appeals division. If you cannot settle with the appellate division, then you'll need to bring an action with the Connecticut Superior Court within 30 days. But as you can see, only 5% of these cases actually end up in court. And as a result, we have very few published court decisions concerning domicile. This, of course, makes it challenging in certain situations to determine how a court would ultimately rule on particular domicile issues, just because there are so few published decisions. So once you're in the appeals division, your case will be assigned to an appellate officer or appellate specialist who will review the findings of the audit division. The appeals officer will likely schedule an in-person conference to schedule the case and see whether it can be resolved. As we just saw, the majority of cases are resolved at the appeals level. If you are unable to settle, however, then a final determination letter will issue. This letter will set forth the final tax liability as determined by the DRS. And again, in order to appeal, you've got to file an action with the Connecticut Superior Court within 30 days of the receipt of this letter. Although this slide is not current, it is the most recently published data by the DRS, and we believe that the trend shown on the slide still holds true today. It shows the assessments by the audit division and final assessments after going through appeals. The big takeaway is that you are much more likely to get a reduction in your tax liability from the appeals division. As you can see, between 2002 and 2007, obviously well over 10 years ago, the appeals division reduced assessments made by audit by 46% on average. That is a significant number, and we're still seeing that hold true today. The bottom line is that in cases where significant tax liability is involved, it is often worth the time and expense of preparing a formal protest and filing it with appeals in order to get a more substantial tax reduction.